Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and global capital markets. I'm your host, Jill Malandrino, and joining me this afternoon, we have Alex Gunz, Fund Manager at Heptagon Capital, John Porter, Chief Investment Officer of Newton Investment Management, and Zehrid Osmani, Senior Portfolio Manager at Martin Currie, a Specialist Investment Manager of Franklin Templeton. They join me to discuss global investment themes, what we should be finding attractive, what to avoid, and outlook as we go into the second half of the year. It is great to have everyone with us, and let's kick it off and get everyone's macro thoughts here, Alex. Starting with you from a global macro perspective, and particularly the impact of what's happening with the Fed in the US and global central banks around the world.
Well, thanks for having me on the show, Jill. It's always a pleasure to be here. And we think this is generally a very good environment for equities. Basically, global growth is looking fairly decent. The path for inflation is heading slowly but surely downwards, and central banks are in a position, again, slowly but surely towards easing. So this is an environment that should be very conducive to equities, particularly as earnings momentum is actually picking up at present. I'd also note that with so much money sitting on the sidelines in cash, $6 trillion at the moment, there's a huge opportunity to see that money deployed.
Yeah. And John, what I think is interesting, and we've been covering this, on the show quite frequently, is that it's very bifurcated. It feels as if there's two different economies, two different markets. What are your thoughts around that?
Yeah, I agree very much, Jill. Some people have described this as a K-shaped economy, and I think that's an apt description. I think there's certain portions of the economy, larger companies, more affluent consumers, that are thriving right now, and the higher interest rate environment is not an issue for them whatsoever. However, I also see other areas of the economy, smaller businesses, the lower income cohorts of the economy that are really starting to struggle with the sustained high rates, and that's becoming an increasing challenge for them. I think as the Fed looks at the landscape, they're trying to thread that needle of not overinflating the economy for those that are doing well, but being mindful of the risks that are posed for some other elements of the economy right now that they're quite concerned about.
Mm-hmm. Interesting, John, because when we were talking about coming out of the pandemic, that it was a K-shaped recovery, and as now we're here talking about a K-shaped in terms of bifurcated economies. But Zehrid, let's talk about this for a moment here. It feels as if inflation is going to be stickier for longer. So how do you think that impacts the Fed's policy?
Yeah, so our view is that when you're looking at inflation, you need to look at wage inflation, because that's by far the biggest contributor in the medium term to inflationary pressures. And wage inflation, whether you look at the US, at Europe, the UK, remains elevated, and therefore there's a potential risk of second round effect on inflationary pressures. So we've heard from the Fed, they're being more cautious in terms of their prospects of cutting rates. We're entering into this cycle. Our view was always that central banks would start cutting in H2 of this year rather than H1. And more or less that's what's happening, even if the ECB has gone 1 month early. But we're really getting into this cycle with monetary policies where central banks are data dependent. Therefore, any inflation prints will bring volatility both in bond markets and in equity markets, as investors speculate about what could be the next moves. It's also an interesting phase for central banks in that they're signaling hawkish cuts, which really sums it up, which is that they're willing to cut, but reluctantly having to admit that inflation is not where they want it to be. So it almost feels like central banks have maybe signaled cuts too soon and therefore need to make a first cut just to please the markets, but then trying to adjust the narrative to really highlight that their focus remains on inflation. And as we know, inflation it remains an important battle for central banks. It's always easier to reignite growth than to extinguish inflation if there's a second round. So it's probably the right approach to make. What it means for corporate earnings, clearly, there will be an element of potential pressure on margins, even if we haven't seen that extensively at this stage. But we would be watching out for any company that struggles in terms of pricing power and therefore could have more pressure on margins. And then we've already started to see more profit warnings in the consumer space. So the comments earlier about a two-speed economy with some parts of the consumers that are getting hit harder by the higher cost of living crisis is absolutely valid.
Yeah. Well, Alex, let's shift gears for a moment here and talk about another area of risk, geopolitical risk that we're seeing happening in Europe. There was a French snap election. And Zehrid, I'd like to get your thoughts on this as well after Alex chimes in. But do you think there's going to be a broader policy shift in the EU as a result of how this is starting to shift?
I think what we've seen consistently, Jill, is that it's very dangerous to try and infer causality from political events. And we saw this clearly back in 2016 with Brexit, with Trump 1.0. And I think there is, without a doubt, heightened uncertainty. But in terms of how we translate that into investment policy, it's really about sticking to the basics, keeping things simple, thinking about diversification in broad multi-asset portfolios, using gold potentially as a hedge. And whilst I think that the French news is certainly near-term uncomfortable, we need to look at it in the bigger picture.
Mm-hmm.
Yeah, from our point of view, what we would echo the fact that geopolitical risk in Europe has increased. And if you look in previous episodes of political flare-ups, the markets tend to overreact compared to the implication. In this instance, when we were looking at the European elections, we took the view that the radical right would increase its number of seats in the European Parliament, but that the majority would stay with the moderates, and therefore European policies would remain unchanged. In the case of France, what we were highlighting is that the real risk is 2027 rather than 2024 with the French presidential elections. The development in France has been surprising by the French president calling for a snap election. And there could be an increased focus there. Clearly, the yields on French treasuries are widening. But what we would highlight is a worst case scenario from this snap election is that the radical right party of Le Pen does get to be in a prime ministerial seat. There would be what we call in France a cohabitation between a president that's moderate and a prime minister that's more radical right. It would probably create a lack of ability to make policy decisions ultimately. The market could potentially see it as a risk to the European integration agenda, but we would go back to it's not so much 24, it's 2027 that will be important. So if the snap elections are a reflection of what could come in 27 with a potential increased risk of a radical right accessing to the presidency, then the dynamics could be different, and then the market would worry more.
Yeah, and then John, shifting gears to the U.S., I mean, we've seen over the past 100 years or so that the markets tend to digest a change in regime, or if it's in fact is the same regime. But I feel like what's happening in the U.S. is more factoring the discretionary spending that we're seeing, the government engaging in.
Oh, absolutely. I think when you look at what's going on in the U.S. economy right now, and I think Alex alluded to this in some of his opening comments, that the U.S. economy is in a pretty good place right now. The nowcasting forecasts look like we're going to have a 3% plus or minus GDP for the second quarter. And historically, in election years, you see, when this is a bipartisan comment, you see a lot of spending, you see a lot of support for the broad economy, and there's certainly seems to be the potential for significant spending this year to bolster the economy. So it seems to me like the risk in the U.S. economy in the short term is overinflating, exacerbating the inflation problem rather than any threats of a recession, which is what we've been, wringing our hands about for a couple of years now, but it continues to be, out in the future to worry about.
Yeah. Well, let's shift gears and talk a moment, John, about how you're thinking about portfolio allocation, whether it's in terms of sectors or asset classes. Do you look at more holistically, or is it more down to a fundamental level where there's some good names and also bad names within certain sectors?
Yeah, at the end of the day, Jill, I'm a traditional stock picker, so I absolutely align with your latter comments. I think there are great stocks in every sector and some bad ones in just about every sector. There's some places that look more favorable. One of the areas that I see a lot of potential in is the healthcare area, up and down. I think that there's been a lot of COVID revealed a lot of problems with the healthcare sector, and I think there's going to be an awful lot of innovation in healthcare over the next 5 to 10 years that are incredibly exciting. When you look at artificial intelligence, which is such a powerful theme, healthcare is going to be one of the biggest beneficiaries of that. So that's one area that looks very attractive to me. Energy looks very appealing right now as well. The supply constraints on the part of the producers is very impressive. They're being very disciplined on in terms of how they deploy their capital, and I think that's improving the returns for the sector. And I think that is going to be a good place to invest from a longer term time horizon as well.
Right. And Alex, I'd like to get your perspective as well, because you tend to have a longer term thesis looking at different sectors that will help the global economy, whether through digitization or technology, to evolve. So what looks attractive to you right now?
Well, I think the points that John made were exceptionally valid, and our stance has always been very much multi-thematic, combining those top-down secular trends with very much the bottom-up stock-picking approach. And just to sort of zoom in on the healthcare sector, one area I'd like to call out is, there's been huge interest in GLP-1, glucagon-like peptide drugs. And actually, we are still, in our mind, very much scratching the surface. You think about it like this: 540 million people globally today have diabetes. Only about 15% of them are in good control of their illness. 800 million people globally are suffering from obesity. Only about 2% of them are treated. And then we're just at the very early stage of treating potentially Alzheimer's using these drugs as well. And that could again be another multi-million opportunity. So that's the story in healthcare. Within energy, just to cover that off, we think that the alternative energy story still has a long way to run. And really, when you frame it in the context of just how much energy is being used really to power anything to do with artificial intelligence, an AI server, just to give you some context, probably requires about 10 to 30 times more energy than a cloud server. So we think the whole energy ecosystem, particularly the suppliers of grid infrastructure and those who are able to upgrade infrastructure, there's some really exciting opportunities there. And that's just two sectors.
Yeah, and Zehrid, you're aligned with this, because I know your 3 key areas are energy transition, aging population, and of course AI as well.
Yeah, that's right. And what's exciting for long-term investors is the effectively almost industrial revolution, as Jensen Huang has put it, that is coming through as a result of AI. We would call it a techno-industrial revolution. So there are business models that used to grow at 5 to 6% annualized in the industrial space that will be accelerating over the next 10 years as a result of the various themes that are being boosted by AI, whether it's robotics and automation, whether it's the cloud infrastructure and all the construction and the building around that, whether it's cybersecurity or metaverse or quantum computing. We think there's a very interesting opportunity for investors to capture some of this investment cycle going on in AI, going on in energy transition, going on in healthcare infrastructure as a result of that aging population. At the same time, what we see is a potential risk of froth starting to come through in AI. So we look at a basket of over 50 stocks. Their share price has gone up by about 44% over the last 12 months, yet their earnings have only been upgraded by 7%. So it's important to focus on companies that can monetize. There are companies, as we know, that have been at the center of that AI investment spend, companies like NVIDIA, and those companies have really shown that their earnings momentum highlights that they can capture that spend quite forcefully. So for investors, it will be important to start differentiating between those companies that will need to spend on AI and that might not necessarily monetize, and those that are the recipients of that outside spend and therefore that can more readily monetize.
Yeah.
Hey, Jill, if you don't mind me asking Zed a question. Zed, I'd love your point about about AI and sort of balancing the short term with the long term, one of my favorite sayings is people always underestimate the change in 10 years and overestimate in 2 years. How do you gauge? Where do you think we are in the AI hype cycle? Because we're somewhere in that curve, but clearly we haven't peaked yet. And the peak still could be another 50% move away, and it's gauging that sort of short term, irrational exuberance, to use a term from the past, and balancing with the current market is a challenge. What do you think?
Yeah, you're absolutely right. Well, we think we're still early, and therefore there's still more upside potential over the next couple of years or so, at least, because of the size of that upgrade cycle that's needed. Notably, the hyperscalers, they're in a bit of an arms race as to who upgrades their cloud infrastructure the fastest. So the incremental capex on what was already high numbers for the hyperscalers and Meta equates to about $130 billion over the next 3 years. This is incremental compared to what they were looking to spend 12 months ago. So that to us will drive that momentum nearer term. But your question is absolutely valid. When NVIDIA was assessing the addressable market in March 21, they put that number at $300 billion. 12 months later, they increased that figure to $1 trillion. And in March of this year, they started bringing in sovereign AI as another opportunity, which we totally believe in. And that's really nascent, but that got them to increase their addressable market to $2 trillion. So even a company that's at the heart of that AI theme is struggling to assess the addressable market or to upgrade it rapidly enough to keep up with events.
Could I perhaps give an extra nuance to this debate, if I may? I mean, I think it's really important to distinguish between the infrastructure layer, which is really where all of the demand and the excitement is happening at the moment, we think, in the application layer. And it's well and good buying these GPU servers at the moment. But I think nearly every business with whom we engage really struggle to actually highlight what the tangible end market solutions are going to be. And I suppose the second framing comment might be the following, that Cisco's thesis back in 1999-2000 was absolutely spot on. The whole world became totally connected with routers, and yet Cisco never ever achieved or attained that valuation it had in 1999-2000 again. And I think our worry is that NVIDIA may be absolutely right in its world view, but whether that is fully reflected in the price is perhaps more open to debate. And really, in terms of trying to move the story on, to try and think more laterally, our approach is really to try and think about second derivatives or indirect beneficiaries of the theme.
Yeah, so for us, we'd be a bit more high conviction, in so much that when you're seeking second derivatives or beneficiaries that are adjacent, you are increasing the risk of being in areas that are more competitive, where barriers to entry are actually collapsing quite rapidly, notably in the application and software space. What we've asked our analysts to do is really kick the tires very hard around what AI could mean, both as an opportunity for innovation, but also as a disruption. And what we're going to be realizing as investors over the next 5 years is that some barriers are collapsing very rapidly. There's already businesses that are being challenged by AI because they haven't been able to keep up. There's debate as to whether some of the big tech companies are late in terms of capturing the AI opportunity. There's discussions that we wouldn't have had 18 months ago about, is Google going to stay the go-to search engine? Or is OpenAI going to be able to have a much more powerful search engine that's AI-powered and therefore will lead to that massive migration by users? Questions we wouldn't have asked before. So when we identify companies that have a quasi-monopolistic position, like NVIDIA does, that also have scale benefit, which means their R&D superiority will remain extremely significant, that are able to therefore drive innovation even faster than previously, we believe that the best strategy is to actually stay with those companies, because you can see that there the barriers are very high and are less likely to be disrupted.
Yeah,
All right, really appreciate. Oh, 30 seconds. We got to wrap. Go ahead, John.
I find myself agreeing with both of them. I think that there's some direct plays on AI, NVIDIA being a great example that you just can't avoid right now. I think it's way too early to worry about the peak there, but there are some electrical component makers, for example, that are big beneficiaries of the CapEx wave that's coming. So I think there's lots of great ways to play AI led by active management.
All right, guys, appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.